Liquidity beats image, process beats motivation, and time beats intensity. The people who become financially unstoppable are usually not the loudest earners or the most aggressive investors. They are the ones who build habits that let them survive bad timing, stay rational under pressure, and keep compounding while everyone else keeps interrupting themselves. So do not think of money habits as small lifestyle preferences. Think of them as invisible control systems that determine whether your capital grows, stalls, or gets destroyed. Let's start with what most people get wrong. They think financial success comes from a few visible actions. One great investment, one big salary jump, one clever side hustle, one period of extreme discipline. That is not how durable wealth is built. Wealth is built by repeated decisions that keep cash flow strong, liquidity available, risk controlled, and capital allocated to productive assets over long periods of time. The market then amplifies those habits. If your habits are weak, the market exposes that weakness. If your habits are strong, the market rewards your endurance. You need to understand the operating mechanism. Markets are not moral. They do not reward effort, intelligence, or good intentions on their own. Markets reprice assets based on expected future cash flows, interest rates, liquidity conditions, volatility, and positioning. That means every decision you make sits inside a changing environment. When liquidity is abundant, risk assets can rise quickly because capital is easy to deploy. When rates rise, future cash flows are discounted more aggressively, which pressures valuations. When volatility expands, weak balance sheets and oversized positions become vulnerable. When positioning gets crowded, even good assets can sell off because too many participants are leaning the same way. The financial equivalent of a biological mechanism is stimulus and adaptation. Pressure changes behavior. Conditions change outcomes. If your habits are strong, you adapt without breaking. That is why the hidden money habits matter so much. They do not just improve your spreadsheet, they improve your ability to respond correctly when the environment changes. Most investors misunderstand this because they focus on surface behavior rather than internal structure. They copy someone's portfolio without copying their liquidity. They copy someone's risk appetite without copying their income stability. They copy someone's conviction without copying their process. Then when the cycle turns, they discover that what looked like confidence was often just comfort in a good environment. The first hidden habit is that you protect optionality before you chase upside. In plain terms, you build a financial life that gives you room to maneuver. You keep liquidity. You control fixed costs. You avoid turning every dollar of income into a permanent obligation. That is a habit because it is not one decision. It is a repeated refusal to trap your future self. Optionality matters because it lets you stay invested during downturns, take advantage of better prices, and avoid selling good assets to solve short-term problems. If your expenses are too rigid, your debt is too demanding, or your reserves are too small, then your portfolio is not really yours. It belongs to the next emergency. So look at how this works in practice. If your job is stable and your income is predictable, you still keep several months of essential expenses in cash or near cash because market opportunity is worthless if you are forced to sell into weakness. If your income is cyclical, you keep more. If the market drops 20% and your income remains intact, you do not panic. You review. You ask whether this is valuation compression, liquidity stress, or fundamental deterioration. If the long-term case is intact, you keep contributing. If prices are cheaper and your financial base is solid, you may even increase contributions modestly. But if your reserves are thin, you do not pretend to be brave. You rebuild liquidity first. That is the habit. You do not confuse courage with fragility. The second hidden habit is that you automate the behavior that matters before emotion gets involved. This is where financially unstoppable people separate themselves from everyone who keeps starting over. You save first, allocate systematically, and review on schedule. You do not wait to feel motivated. You do not depend on how disciplined you feel after a good week. You move money on purpose and on time. This matters because cash flow is the raw material of investing. If earned income is not consistently converted into retained capital, then there is nothing for compounding to work on. The market mechanism reinforces this. Prices move for reasons beyond your personal narrative. Momentum, earnings revisions, liquidity flows, and positioning can move assets far away from your emotional comfort zone. If you have no system, you will interpret that movement personally. Rising prices will tempt you to chase. Falling prices will tempt you to quit. A system breaks that pattern. You know what percentage of income gets saved. You know what portion is reserved for liquidity, what portion goes to long-term investing, and what small portion, if any, is allowed for tactical risk. You know your maximum position size. You know how often you rebalance. You know what you are trying to achieve with each pool of money. That is not boring. That is operational strength. Now apply it. If you get paid twice a month, contributions happen automatically each time. If you receive variable income, you set a base saving rule and an overflow rule. Maybe a fixed percentage of every dollar above your baseline income goes directly to reserves or investments. If markets are expensive and rates are rising, you do not stop investing and sit in analysis paralysis. You continue contributions, but you keep expectations realistic and position sizes controlled. If markets are strong and people around you are suddenly talking like every risk is safe, you do not increase exposure just to match the noise. You check allocation drift. If one asset class has grown too large relative to your plan, you rebalance. That is how you avoid turning a good trend into a future regret. The third hidden habit is that you separate time horizons with almost obsessive clarity. This habit is more powerful than it looks because it prevents category errors, and category errors destroy wealth. Money needed in the near term should not be treated like capital with a 10-year runway. Money for long-term compounding should not be judged by next month's volatility. If you blur those two, you will either take too much risk with short-term money or too little risk with long-term money. Both errors are expensive. This matters because the market does not move on your schedule. Long-duration assets can become highly sensitive when rates rise. Tactical opportunities can fail even if the long-term thesis remains intact. A broad equity index may be entirely appropriate for a long-term investor and completely wrong for someone who needs that money next year. So you train yourself to ask one question before any allocation decision. What is the actual time horizon of this capital? If the answer is 12 months, you protect principal and liquidity. If the answer is 10 years, you accept measured volatility in exchange for growth. If the answer is uncertain, you bias toward flexibility. Most people misunderstand this because they speak in slogans. They say buy the dip without defining the time frame. They say long term without checking whether their own balance sheet can survive short-term stress. They say just hold without distinguishing between temporary volatility and permanent impairment. Financially unstoppable people do not rely on slogans. They classify the decision, then act. The fourth hidden habit is that you reduce ego exposure. This one is rarely discussed because it sounds psychological, but it has direct financial consequences. Ego makes you oversize winning ideas, defend bad entries, ignore changing conditions, and treat the market like a referendum on your intelligence. Once that happens, you stop allocating capital and start managing identity. That is dangerous. The market does not care how smart you felt when you entered the trade. It cares about liquidity, positioning, earnings power, and time. So you create habits that keep ego small. You define position size before you enter. You define your exit logic before price action starts talking back to you. You write down what would invalidate your thesis. If the market moves sharply against you and your reasons no longer hold, you reduce or exit instead of negotiating with reality. If the market moves strongly in your favor, you still check concentration and correlation instead of assuming success proves you were right about everything. That is how you stay dangerous in a good way. You remain adaptable. This is where most people stop. But this is the advanced level. Once you have liquidity, automation, time horizon discipline, and controlled ego, you start paying attention to second-order effects. A rate hike is not just a higher rate. It changes refinancing conditions, consumer demand, startup funding, credit spreads, equity multiples, and bankruptcy risk for weak balance sheets. A rising market led by a narrow group of assets can be more fragile than it appears because breadth is weak. A falling asset is not automatically more attractive. If liquidity is disappearing and forced sellers are entering, lower price can mean worse odds. Correlation breakdown matters too. In calm markets, diversification looks simple. In stressed markets, assets that seemed unrelated can suddenly move together because liquidity and fear become dominant drivers. This is where hidden habits become advanced protection. You stop asking only whether an asset is good. You ask what regime you are in. Is liquidity expanding or tightening? Is volatility compressing or expanding? Is crowd positioning stretched? Are you dealing with a valuation problem, a solvency problem, or a temporary dislocation? If you do not ask those questions, you can average down into a liquidity trap. Overweight assets that only worked in cheap money conditions. Or assume diversification exists where it really does not. And this is where bankruptcy mathematics matters. Losses hurt asymmetrically. A 50% drawdown requires a 100% gain to recover. Leverage is not just a return enhancer, it is a fragility amplifier. Oversized positions do not merely increase upside, they increase the probability that one wrong call damages your future compounding. Once debt service pressure rises while cash flow falls, outcomes can deteriorate very fast. That is why financially unstoppable people often look conservative from the outside. They understand that survival is not passivity. Survival is the foundation of every future gain. Now bring this back to daily behavior. Suppose markets rally hard and fast. Social media fills with stories of easy gains. Your speculative watch list outperforms your diversified portfolio. The weak habit is to feel behind and start reaching. The strong habit is to check breadth, valuation, position size, and regime. If optimism is expanding but leadership is narrow, you do not assume strength is broad-based. If you take tactical risk, you cap the size so the downside cannot damage the core system. If you cannot explain your exit condition clearly, you do not enter. If you are tempted to double because recent price action feels validating, you pause. Momentum can continue, but that does not mean your risk budget should disappear. Now suppose the market drops 15% in 6 weeks. The weak habit is panic or denial. The strong habit is staged analysis. First, you check your own balance sheet. Is your liquidity intact? Is your income stable? Are your obligations manageable? Then you check the market environment. Are earnings expectations deteriorating? Are credit conditions tightening? Is this a broad repricing or a solvency event? If your long-term thesis remains intact and your time horizon is long, you continue scheduled buying. If your allocation is now far from target, you rebalance deliberately. But you do not convert paper volatility into permanent damage with emotionally timed exits. Suppose your own income weakens. That is where the quality of your habits becomes visible. If your system was fragile, pressure will expose it immediately. If your habits were strong, you will have options. You can reduce new investing temporarily without dismantling your future. You can trim discretionary spending without touching core stability. You can shift toward more liquidity without abandoning your long-term structure. Optionality is the clearest sign that your habits are working. To practice these habits, you need process, not inspiration. Keep a monthly record of your savings rate, liquidity coverage, investment contributions, debt service burden, and portfolio concentration. Before every meaningful financial decision, journal the thesis, the time frame, the position size, the risk limit, and the condition that would make you change course. Then reverse test it. Ask what would have to happen for this decision to fail badly. Ask whether that outcome is truly unlikely or simply uncomfortable to imagine. Run basic simulations. What happens if your income drops 20%? What happens if your largest position falls 35%? What happens if inflation stays sticky and your fixed expenses rise? What happens if assets you assumed were diversifying start moving together? That is how you train composure before the environment demands it. To maintain these habits, build evaluation loops. Review cash flow monthly. Review allocation quarterly. Review lifestyle creep every 90 days because small upgrades compound just as surely as investments do. Track metrics that matter: savings rate, months of liquidity, percentage of income committed to fixed obligations, portfolio concentration, error rate, and recovery time after mistakes. When you make a bad decision, do not stop at the financial result. Identify the process failure. Were you too early, too large, too dependent on one narrative, too lazy about liquidity, or too vague about time horizon? The lesson is usually hiding in the process, not just the outcome. Then integrate these habits with other tools. Use valuation to understand what price implies. Use macroeconomics to understand the environment shaping those prices. Use technical analysis to observe how participants are behaving in real time. Use risk management to make sure even a good idea cannot damage you if executed badly. Each tool corrects the weakness of another. Valuation without macro can trap you in assets that look cheap but remain pressured under tightening conditions. Macro without technicals can make you early and ineffective. Technicals without risk management can make you reactive and overconfident. Risk management without a thesis can keep you safe but directionless. Integration is what makes the habits durable. And then you test them under pressure. Use paper trading to rehearse decision-making and expose your impulse patterns. Use small-scale real positions to see how your behavior changes when real money is at risk. Do pre-trade risk analysis before anything outside your standard plan. Stress test your assumptions when headlines are loud, not when everything is calm. The point is not to become fearless. The point is to become organized enough that fear does not take over your allocation process in real time. So when you ask what hidden money habits make you financially unstoppable, the answer is not glamorous. You protect optionality. You automate capital formation. You separate time horizons. You reduce ego exposure. You study regime change. You practice decision-making before pressure arrives. You evaluate process, not just outcomes. You build a system that lets you keep going when other people keep resetting. And here is the detail worth replaying because it is easy to miss the first time. None of these habits look extraordinary in a calm market. Their power only becomes obvious when conditions tighten, volatility rises, or your own life becomes less predictable. That is when invisible habits turn into visible advantage. That is when you find out whether your money is being managed by intention or by circumstance.